Hello, everybody. This is Ellman, the blue collar investor, and welcome to this BCI podcast number 75 titled Reverse Stock Splits Understanding Contract Adjustments. Every so often, the option contract that we sold will all of a sudden seem to change when we take a look at an options chain. Those are usually due to contract adjustments. So what exactly are contract adjustments? These are changes made to the option contract by the Options Clearing Corporation due to underlying corporate actions. Some of these actions include stock splits. We're all familiar with 2-for-1, 3-for-1, 3-for-2 stock splits, mergers and acquisitions, special one-time cash dividends, and the subject of this podcast, reverse stock splits. So let's define a reverse stock split. It's a reduction in the number of corporations' outstanding shares in order to increase the value of each individual shares. So this results in making the shares look more attractive to institutional investors that may have some kind of a minimum threshold on the prices of the securities they would consider purchasing. It also may address some exchange delisting concerns because some of the exchanges require the pricing of certain securities to meet some minimum threshold. So when the price of a security starts going down close to that threshold, a corporate board may decide to do a reverse stock split, thereby cosmetically increasing the price of the stock, although the total value of each position doesn't change. Now, these actions are actually made by the company, but the corresponding adjustments to the option contracts, those are handled by the Options Clearing Corporation Securities Committee. And they want to make sure that call and put buyers and sellers are made whole. So there's nobody out there that will have an advantage or a disadvantage when these corporate actions take place. Let's have a look at the option symbology components. An example here. Well, the first thing we notice that an option symbol consists of is the ticker symbol of the underlying security. Those of you watching this podcast, it's Intel, INTC. Now, the next thing that you'll notice is the actual expiration date of that particular option contract. It'll include the month, the day, and the year of the contract expiration. In the middle of the option symbol, there'll be either a C for call option or a P for put option. After that will be the strike price of the particular option. So those are all included in the typical options ticker symbol. Now let's look at some of the definitions we have regarding an options contract. First, let's look at the multiplier. The multiplier is the number used to calculate the total premium. So it's generally 100. That's the standard multiplier for an options contract. So let's say a premium on an options chain is listed at $2. Well, that if we're using a standard multiplier of 100, that means it would cost $200 to buy one contract. Another term used for contract definitions is deliverable, and that defines the unit of trade. It could be a stock, it could be cash, that changes hands upon exercise. So normally in a typical standard options contract, let's say for stock or an exchange traded fund, for each contract, there are 100 shares of deliverables, again, be it a stock or an ETF. Now let's have a look at the type of contract adjustments specifically for reverse stock splits. The number of deliverables are decreased. That's the main change to a reverse split contract. So if there was let's say a 1-for-5 reverse stock split, as I'll show you in a moment, that means instead of delivering 100 shares, it'll deliver 1/5 that amount, 20 shares. The option symbol itself will also change. It'll be given a different designation so you could distinguish it from the original options ticker symbol. And then after the split, there will be a new class of options reflecting the standard terms and the updated strike prices based on the higher value of the underlying security. Now, adjustments are not made for the following components. The number of contracts in the account, that stays the same. It's just the deliverables that are decreased. The strike prices, again, stay the same until after the split occurs. And the multiplier still remains 100. So if it's listed at $2, it'll still be $200 to buy one contract, but the number of deliverables and the price will change according to the reverse stock split. Now, back in March of 2020, we're going to look at a real-life example now of Ellman AMLP ETF, which trades on the New York Stock Exchange under the ticker symbol AMLP. And we could see there was a huge dive in the price from 42 down to 12. It went as low as $5 a share back in March, and then it did recover. So the post-split prices, when you're looking at a price chart, went from 42 to 12 from February through March 2020. That's when the company made a decision to institute a 1-for-5 reverse stock split. So if you looked at the actual publication by the Options Clearing Corporation, you would see that they announced the 1-for-5 reverse stock split where for every share owned, you would receive 0.2 or 1/5 that amount of shares. So the deliverables changed. The multiplier stayed the same at 100, and there were 20 shares per contract deliverable after the reverse, as related to the reverse stock split. And the ticker symbol for the security changed from AMLP to AMLP2D. And so for every share owned, 0.20 shares will be owned post-split, and the effective date of the split was May 18th, 2020. So once again, the deliverables changed and the ticker symbol changed, but nothing else. Now, after the split, if you took a look at the option chain, you would see that the pricing, as far as the strike prices for AMLP, now reflected the new price of AMLP. And you could see, if you're watching this podcast, that AMLP had strike prices in the $25 to $28 range, which meant pre-split the prices would have been in the $5 to $5.50. So you can see cosmetically, it appears to be a stronger stock, but not really. So you have to really understand that usually reverse stock splits represent and show a weakness in the underlying security. Let's summarize. Reverse stock splits are generally initiated when the price of a stock substantially declines. Once again, it's a sign of weakness. The value of your total position, though, remains unchanged, but companies feel that they will benefit by making this cosmetic adjustment. Now, the components of the option contracts that are adjusted are the ticker symbol and the number of shares delivered. The other components are not changed. Before I go, as I always do, I just want to remind you of the myriad of free resources on the bluecollarinvestor.com website. Check out our free resources link on the top black bar. We have calculators, we have files. Check out our Beginner's Corner tutorial, free, two 8-part video tutorials on covered call writing, the other on cash secured puts. And our line of products in the bluecollarinvestor.com store, which includes books, online streaming video programs. It includes as well calculators, spreadsheets, trade planner, and online mentoring programs. So there's a lot of educational products, both free and available in the bluecollarinvestor.com store, which will bring you to a master's level in selling covered call and cash secured put options. Folks, thank you so much for taking the time to listen to this BCI podcast, number 75, Reverse Stock Splits, understanding contract adjustments. Hope you enjoyed this podcast, and most importantly, I hope it puts some money in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.